Hey guys, welcome. So something that obviously affects a lot of us as traders is when we're on the end of a winning trade, and I'm talking about a swing trade here, although it does this will actually apply to day trading as well. How do we trail our stop loss? So let's say we have a target that's quite a distance away, but at the same time we don't want to give back all of that trade just because it hasn't quite hit the target. So we want to scale, we want to trail, should I say, a stop loss in our direction to kind of ratchet up those gains, to make sure we lock in some of those gains. So how do we do that? Let's just think of some ideas of using a trailing stop in Forex trading. So I happen to have a US dollar CAD up here at the moment. It could be any chart, could be any time of day. We're just using it as a pure example. And let's say we're now short and the trade is going our way. Obviously, that is what would happen if we're trailing our stop. It doesn't apply if we're wrong. It applies that we're right. It's moving our direction. But we want to get the balance right between, if we tighten up too much, you're going to get pinged down the first little bit of noise. If you have it too wide, you're going to give back too much profits. So it's that sweet spot. And it's going to depend on what market you're trading. It's going to depend on the average true range of the day. It's going to depend on all these kind of things. But let's look at a couple of ideas and the way we can do it. So the first thing we can do is we can literally just have a fixed tick or a fixed pip value. So let's say, as soon as the market moves 50 pips in our favor, we run a 50 pip trailing stop. In other words, the basic means that we just literally, if the market pulls back 50 pips, we're out. So it pulls down to here, say, what's that, 1.3390, pulls back up, we're going to be out. So that's going to ping us out there, but it's going to keep us in for the whole of this move. We're not going to capture the whole move here, but it's going to keep us in for this move here, because this is more than a 50 pip pullback. We're going to get taken out on here. So fine, that's quite tight. Let's say we went to 200 pips, for example, then that's going to keep us in for this move, and that's probably going to keep us in for the whole thing. But ultimately, don't forget, we're going to have to give back 200 pips at the end before we get anything that goes well. And also, let's not forget, if it goes 200 pips in your direction and comes back and you're using a trailing 200 pip stop, you're going to have to give back all those 200 pips. So you can kind of use a hybrid as well. You can say to yourself, listen, for the most risky part of the trade, i.e. the beginning part of the trade, I'm going to use 50 pip trailing stop, okay? And when I have, let's say, 100 pips, 100 ticks in the bag, whatever it may be, $100, whatever instrument we're trading, depends, could be percentage, whatever. You then say, okay, now I'm going to widen it a bit. I've got a little bit there. Now I'm going to give it a little bit of flexibility. I've tightened it up as the most risk is on the trade in the first part of the trade. It's gone my direction. Now let me give it a little bit more room. Let me ease the stop back to 200. Let me use a 200-point trailer. And then you can even tighten it up as you start to come to support. Let's say we looked at this chart and we saw some support here. We can even tighten up as we hit that support. We could tighten up to a 50-point trailer. So we don't want to get caught out in reversal. And if it breaks through again, then we can widen it back up again. So we can use a little bit of variability there. And I quite like, using a little bit of discretion with my trading, allowing myself a little bit of flexibility when I'm talking about trading or even entering or whatever it may be. Now, another thing we can do is we can say, okay, I'm going to wait for, let's say I'm short, let's use an example short, and we can flip it on its head for long. I'm going to wait until a key resistance level forms, and then I'm going to put my stop above that. So the market pulses in your direction here. We form a little bit of resistance here, so then we put our stop just here. Okay, our stop would be just above that high there. We'd roll over again, we'd wait for some resistance to occur, and I guess you'd have to probably put it about here. See, obviously the thing about this is you don't know how far that's going to go. That could come right back up. So you're going to have to add another layer of stop into this. But once you've put in that high, or that cluster of highs, then you can put your stop above it and say, okay, now I've brought it down. Here again, a little bit cluster of resistance here. You put your stop here, pulling down here, waiting for a cluster of resistance. Now, of course, if we spring straight back up here, you're going to have to give some back, or you're going to have another layer of risk management in place that doesn't allow that. But this is kind of a bit more dynamic and a lot less fixed in terms of, allows for the market to stretch really aggressively in one direction, because if you're using a fixed, say, 50 tick, it might just stretch in one direction, ping back intraday, and in reality, it's just because it's gone so deep that it's pulled back 50 ticks. Whereas if you're kind of waiting for that cluster to form, then it's a little bit more dynamic, adjust to the volatility of the market, that kind of thing. Okay, another thing that you can do, there are multiple ways, guys, and these are just some ideas out there, and let me know in the comments below how you trail your stops. You can use something like a moving average. So for example, you come down here, this obviously looks a little bit on the tight side, but let's say you were short, just for argument's sake, not cherry picking or anything like this, but we're just using it as an example. Let's say we're short on this breakdown here, it's going your way, and you're using that. If there's a close above the 20 period moving average, or a 10 period, a little bit aggressive, but whatever you decide to do, then you come out. So you literally just say, listen, don't care what price is doing, you know, I'm going to come out if we close above it. Obviously, you have to be prepared to give back a fair bit. You know, that's a fair distance from there to there, and that's what will happen as we start to get stretched away from it. It'll take a while for the moving average to catch up. So if we rip straight back up the next day, you're going to give it back. But in most of the time, guys, the moving average will catch up slowly. Even if this starts to counter trend, the moving average will come down and they will converge, and you won't end up giving back so much, but it will keep you in the trade for longer. It's a good way of keeping you in the trade for longer. And in fact, let's move that and change that to 50 period. Obviously, the higher the time frame, the more we give back, but then the longer we stay in the trade, you know, as we know that. If we are, just a little tip here is that, let me change it, we go back on here. If we have it really aggressive, like a 5 or a 10 period, okay, that keeps you in like 3 or 4 day momentums. So if you really think you've spotted some momentum, okay, you're selling a breakout, let's say you're selling this breakout here, right? We've gone in, we've sold this breakout, we identified this. This will keep you in the trade while the momentum is there. You're going to get stopped out very quickly, but it's very, very tight. So you can see as we're rolling down 1 day, 2, 3, 4, 5, 6, 7, 8, 9. In fact, I don't think it's closed above it. Let's give it the benefit of the doubt and say, okay, you actually closed above it here. I don't think it did. I think you're actually genuinely still in this, but that may have closed above it. But anyway, the point is it keeping you with that initial pulse. So if you're looking for that 1 to 5 day kind of burst, breakout or something, if we go back and let's very quickly go back while I think about it, to US dollar yen breakout we had a while ago. If I can type it in correctly, this is the sort of thing that will keep you in the trade, you know, really, really keep you in it. Now, you obviously going to get stopped out a lot on this because it's very tight, it's very aggressive. But let's say you've traded this, you've bought this breakout, this channel. We had a downtrend channel here, remember this a long time ago? We had a downtrend channel here. Forgive my drawing, but we broke out of it. And let's say you bought that breakout and you're really tight, aggressive, used a 5 period, which is very aggressive, but that kept you in for all this period here, all the way up, and finally you came out here. So you're out in the first pullback, which you might not want to be because the first pullback's often a very good time to get involved, but literally it stops you getting caught on a fake out. You're literally getting really pushing that volatility, and look how many closes you get in a row above it, and then it comes back and finally there's your exit. So you've got to adjust it to suit, and you know, there's some ideas there. You can use a conjunction of the two, using moving average, on a trade it really aggressively or leave it a little bit loose, ratchet up a trading stop in terms of pips. You can do things as well, like we didn't talk about, but an average true range of the day, using perhaps, you know, 1 full range of the average true range, or using 2 times the average true range, something like that. You can add some flavor to it and mix and match. But the point is, again, you've got to obviously keep it in terms of what your goals are as a trader and what the setup is. If the setup is a pure volatility expansion, maybe you do want it quite tight. If you think the setup is for a longer term mature play that's going to pull back multiple times before it carries on, then give it a bit more width, give it a bit more room. You don't want to be pinged out on noise. So finding that sweet spot, using a conjunction of trading, fixed trading and moving averages, and you can really nail, really pay the market, pay you for being right on the trade. If you like this video, guys, give it a thumbs up. Don't forget to subscribe if you haven't already. Leave a comment in the comment section below how you trail your stops. Have you got a specific indicator you like to use for it? Do you just kind of wait until you hit your target and that's it? Do you not employ trading stops, or how do you trail your stops? It's interesting to hear what you guys do. Let me know, as I say, in the comments below. Take care, guys. Good trading. See you soon. Bye bye.